Welcome to the Deep Dive. Today our mission is really focused. We're tackling the big strategic shifts happening around the FLR network. That's FLR. We've got some deep technical sources on its protocols, but also major news about its financial structure. And, well, these two things are deeply connected.
Absolutely. I think the main thing we want you to grasp today is how FLR positions itself. It's aiming to be the blockchain for data. That core idea, securely accessing all kinds of external information, it's ambitious. So ambitious, actually, that it seems to have needed this big financial reassurance move, which is exactly why their early backers agreed to restructure their whole investment deal in mid-2025.
Right, and the sources we pulled together really show this. We're looking at the extended vesting for backers, these significant reinvestment pledges. But crucially, we're also digging into the mechanics of FLR's core data protocols, these enshrined protocols, the FLR Time Series Oracle, or FTSO, and the FLR Data Connector, the FDC.
And we've also tracked how the market's reacting. You know, the growth in XRPFi adoption, all that FXRP being minted, and even some, frankly, surprising institutional signals. There was that ETF filing attempt late last year, which is interesting.
Okay, let's unpack this. I think we really need to start with the engineering side. Because if FLR actually delivers on this secure, decentralized data layer, well, that changes the game for cross-chain DeFi. So let's look at the engines behind that vision. FLR's EVM compatible, uses proofs of stake. Standard stuff so far. But the key is that its main protocols are enshrined. What does that actually mean in practice?
Yeah, enshrined is the key word. It means these protocols aren't just smart contracts running on FLR. They're baked into the core blockchain layer itself. So they inherit the network's full economic security. The data they provide is essentially guaranteed with the same strength as the network's own transactions.
Okay, so the FTSO isn't just some Oracle application someone built on top. It's fundamental, part of the structure. So what do these two enshrined protocols, FTSO and FTC, actually do?
Well, the FTSO, that's focused on time series data. Think of it like the network's built-in decentralized price feed system. It gives fast, secure prices for pairs like FLR USD or, importantly, XRPUSD. The FDC, on the other hand, deals with verifying external events. Did a specific transaction happen on Bitcoin? Did a certain API return a specific value? That's the FDC's job.
And that connects directly to FLR's big use case, right? Facets.
Yeah.
That whole system needs this solid data infrastructure to securely bring assets like XRP, Bitcoin, Doge onto FLR. So you can use them in DeFi, minting things like FXRP. You just can't do that safely without reliable, decentralized data feeds for price and events.
Exactly. You absolutely need both. And to really appreciate the security, you kind of have to look under the hood at how the FTSO works.
Okay, let's start there. The Price Oracle, FTSO. Who are the players making sure this system is decentralized and, trustworthy?
Right. You basically have two main groups. First, the data providers. They're the ones actually sourcing price data using their own methods. Second, you have delegators. These are people holding Spark, the FLR token, or F assets. They delegate their voting power to the data providers they trust. And what's really critical here is that when they delegate, their tokens never leave their own wallet. It's risk-free for the delegators.
Okay. So you delegate vote weight, not the actual tokens. And the voting itself, how does that avoid manipulation? Like front-running, you mentioned commit and reveal.
Precisely. It's a two-step process. First, providers commit by submitting a cryptographic hash, basically a scrambled version, of their price estimate. Nobody can see the actual price yet. Then, in the reveal phase, they show the actual price. The FTSO system then calculates the final price feed using a weighted median. That median is weighted based on the total delegated vote power behind each submitted price.
And this is where the incentives kick in hard, right? They only reward the providers who are close to the middle.
Yes, spot on. They only reward submissions that fall within the middle 50% of all revealed prices. It's called the interquartile range, or IQR. If your price estimate is too high or too low outside that central band, you get 0 rewards in Spark tokens for that round. It creates this really powerful economic pull towards consensus. Submit accurate prices that align with everyone else.
Wait, let me push on that a bit. If the IQR forces everyone towards the middle, towards conformity, isn't there a risk there?
Yeah.
Like, what if the market moves super fast or one provider has genuinely better, faster data, but it's outside the current consensus? Could it stifle accuracy for the sake of getting rewards? Groupthink.
That's a really fair question. It's the fundamental tension in designing any decentralized oracle. But the IQR approach, by focusing on the median rather than the average, is designed to be robust against manipulation. Rewarding closeness to that central consensus makes it economically punishing for outliers, which are often either errors or, worse, attempts to manipulate the feed. To actually skew the median significantly, an attacker would need a huge, economically infeasible amount of the delegated vote power. It's a defense mechanism.
Okay, that makes sense. It's a trade-off favoring manipulation resistance. So that's price data via FTSO. Now let's switch to the FDC, the FLR data connector. How does FLR verify an event, say a transaction on another chain, like the XRP ledger? How does it know it really happened and bring that knowledge securely onto FLR?
Right, so the FTC uses a similar concept but for events. It's called the Request Commit Reveal Protocol, or RCR. A user basically requests verification and attestation for some external event. This kicks off a consensus round among attestation providers. They go out, check the proof of that event on its native chain, and then commit and reveal their findings. Each phase, request, commit, reveal, currently takes about 90 seconds.
And it can handle different kinds of chains. Like Bitcoin doesn't have smart contracts in the same way Ethereum does.
Exactly. It's designed to be versatile. It can verify transactions or state changes on non-smart contract chains like Bitcoin, Dogecoin, XRP Ledger, and also on smart contract platforms like Ethereum or testnets like Sepolia.
What's the security guarantee? Is it just trusting a default set of these attestation providers?
No, and this is a key point. While there might be default providers for ease of use, the real security comes from the fact that anyone can run an independent node with what they call a local attester. These independent nodes check the results too. If the main set of providers tried to attest to something false, these local nodes would just discard that outcome because it doesn't match reality. It's a backstop.
Okay, so the event gets verified by this FTC consensus.
Yeah.
How does a smart contract on FLR then use that information trustfully?
Good question. The contract doesn't just get a yes or no. It receives the verified result plus something called a Merkle proof. This happens via FLR's data availability layer.
Yeah.
Think of the Merkle proof as like a cryptographic receipt. It mathematically proves that the data the contract is seeing is exactly the same data the FTC providers reached consensus on about that external event.
Got it. So the smart contract isn't checking the Bitcoin transaction itself. It's verifying the FTC's receipt for that transaction.
Exactly. So a developer could, say, build something on FLR that reacts to a specific USDC transfer happening on Ethereum. They'd request verification via FDC. The FDC confirms it, provides the Merkle proof, and the FLR smart contract verifies that proof, then executes its logic. It's a secure bridge for external state, multi-layered security.
Okay, the tech is definitely impressive. Enshrined protocols, commit reveal, Merkle proofs.
Yeah.
It's robust. Let's pivot now from the code to the money side, because all this great tech, well, it doesn't automatically mean market stability, right? Which seems to be why we saw that huge financial agreement in mid-2025.
Yeah.
Was that just good faith, or were backers feeling pressure?
I think it was definitely strategic, probably necessary, honestly, to give the project long-term breathing room and align everyone.
Yeah.
So yeah, the July 2025 tokenomics update, the headline was that early backers agreed to extend their vesting schedule significantly, push their entire token release out to Q1 2026. That single move delayed, what was it, over 1.3 billion FLR from hitting the market. A big reduction in near-term supply pressure.
And they didn't just delay, they added actual rules about selling too.
That's right. Those investors are now limited. They can't sell more than 0.5% of the average daily trading volume over 30 days. It just smooths things out, prevents sudden dumps. But maybe the most interesting part is the reinvestment pledge.
Right. This is where the investors who, stood to gain the most from selling, they actually have to put money back into the ecosystem. They pledged what? 50% of whatever they sell gets reinvested in FLR projects?
At least 50%, yeah. Based on valuations around that time, the estimate was that this could inject around $35 million in fresh capital. And it's earmarked for foundational stuff. Lending protocols built on FLR, DEXs, stablecoin projects. It turns early backers into ecosystem VCs, essentially. Their success becomes tied directly to the network's growth. And remember, this came after an earlier move in October 2023. Back then, a different group of investors agreed to own 2.1 billion FLR from their share. So the total slice allocated to early investors ended up being just over 3% of the original total supply. Tiny, really.
Yeah. Wow, okay. That's serious commitment. Reducing the overhang, locking in capital. Let's look at traction then. The big story seems to be XRPFi.
Yeah, that's where the usage is really taking off. Since September 2025, the Facet system has seen over $120 million worth of FXRP minted, synthetic XRP on Flare. And that activity directly pushed Flare's total value locked, the TVL, up by 40% in just 6 weeks. It really cements Flare as kind of the go-to place for XRP holders wanting to access DeFi.
And we even saw some institutional nods, right? That Teucrium filing for a Flare ETF in November 2025. Obviously, regulatory hurdles are huge for crypto ETFs, but the filing itself is a signal.
It absolutely is. But, looking at the community and market sentiment, it's a bit mixed. The bulls, they look at the strong XRPFi growth, the huge token burns, like you said, 2.1 billion FLR burned just year to date and see massive potential.
But the bears, they have arguments too. Risk of reward dilution for stakers, maybe. And the fact that the FLR token price hasn't really kept pace with that TVL growth. It dropped, 38% in one 30-day period despite all that activity.
That's the key counterpoint. It suggests that while people are definitely using Flare's utility, especially facets, they might be parking value in stablecoins or yield farming with FXRP rather than strongly accumulating the native FLR token itself. That's a disconnect.
Right. The utility is there, but the value capture for the native token is maybe lagging. That's the challenge.
Exactly. Bridging that gap between high utility demand and native token accumulation, that's the big task for Flare moving forward now that the tech is maturing.
Okay, this has been a proper deep dive. I think that core idea we started with holds up. Flare is making a massive bet on being the secure, decentralized data layer. It's underpinned by these unique, enshrined protocols, the FTSO and FDC. And that big financial restructuring, the longer vesting, the sales limits, that $35 million reinvestment pledge, seems like it was a necessary, almost surgical move to align everyone behind that ambitious long-term tech vision.
Yeah, definitely. And looking ahead, the key things on the roadmap are the mainnet launch for Facets, which was targeted for Q4 2025, so it should be live or very close now. And importantly, continuing to scale the FDC, the data connector. Their stated goal is pretty ambitious.
Oh, yeah.
They want to scale it from the current, say, 60 decentralized data streams it supports up to over 1,000 streams.
1,000 data streams. Wow. Okay, so that actually brings up a final thought, maybe something for you, the listener, to consider as Flare pushes for this scale. How do you scale that massively? Going from 60 streams to over 1,000. How do you manage that huge increase in data volume and the number of providers needed while still maintaining that core promise of decentralization? More providers, more complexity. Doesn't that inevitably introduce new potential points of failure or centralization risk if you're not incredibly careful?
That's the fundamental challenge, isn't it? Balancing massive data scalability with that absolute need for robust, decentralized security. It's the tightrope walk for pretty much all data-focused blockchains going forward.